Welcome to the MUFG Global Markets Podcast. I am your host, Ellen Tang, and I'm joined today by Glenn Schultz, who is the head of our agency mortgage prepayment modeling and strategy for MUFG. Today is Wednesday, March 9th, and Glenn, thank you again for joining us this month.
Great. Yeah, thank you, Ellen, for having me on the show. It's a pleasure.
February remittance data was released on Friday the 4th, and prepayment rates measured by the Fannie Mae 30-year MBS declined 10% on a month-over-month basis. But I noticed that you changed the lead on your client note from a discussion of aggregate speeds to a discussion of the quarter-over-quarter comparison of the S-curves. Glenn, why did you choose to lead with this particular analysis?
Yeah, you're right. I usually lead with aggregate prepayment speeds to kick everything off, but the quarter-over-quarter changes actually caught my eye, and it was really just a little bit of a subtle shift from the previous month, but it was a continuation of a trend that obviously I've been watching with a lot of people as far as the refinance wave is concerned. And I felt that they really showed a turning point in prepayment rates away from a refinance dominated market to that of a turnover market and resurgent burnout. So specifically, if you look at it, the Q1 2022 curves now lie below those of the previous 4 quarters. In the money speeds are considerably lower, and burnout is visibly demonstrable in the seasoned cohorts. So that was, I think, something that really caught my eye. And then finally, the out of and at the money turnover rates are modestly higher than the previous 4 quarters, right? So I find that there's a significant shift here in the sense that refinancing has kind of fallen off. But at the same time, we've seen turnovers begin to pick up, right? And so when there's a significant shift like this in the S-curve, it's usually an indication of a change in the overall characteristic of prepayment. So in this case, it leads me to the conclusion that the prepayment paradigm is shifting noticeably to a turnover burnout sort of paradigm and away from a refinance paradigm.
Got it. Thanks for that explanation, Glenn. Through the refinance wave, we talked a lot about the expected horizon of the refinance wave, turning points, and the point of terminal velocity or maximum prepayment. What are your thoughts with respect to the transition away from the refinance environment to a turnover environment, and how do you see that unfolding going forward?
Sure. Well, there's a couple of points that I've been considering, right? So the first being the final remnants of the last refinance wave, right? Or the refinance wave that we just come out of. And I think these are mostly the new and moderate seasoned cohorts, predominantly high FICO or higher loan to value cohorts, right? So they were always already originated with a above sort of market rate in terms of the mortgage rate. So it's within these cohorts that I think originators will likely have, refinance success due to borrower credit curing, home price appreciation, and then of course, refinance opportunities will probably exist in these cohorts. I'd say up to like a 4.5 or 4 3/4 mortgage rate. And then there's just kind of the pure, probably equity takeout refinances that we'll see as a matter of course of business. Then the second is demographic. So I looked at the 2021 census population estimates, and they showed considerable migration to the South region, with the Northeast region losing population, right? So this is important because migration does affect sort of prepayment patterns. So the migration is likely related to things like retirement, maybe state tax preference, working from home, COVID-19, those types of things. But what I found interesting is that 33 states saw population increases and 17 states in the District of Columbia lost population. So this is a historically large number of states to lose population in a year. So this tells me that migration in the U.S. seems to be picking up after a period of being kind of suppressed following the financial crisis, and by extension, then turnover will follow, and that I think turnover will follow and be sort of above the normal that we've grown accustomed to. And third, the housing stock and existing home for sales. So I think we're seeing a renewed demand for housing as the millennial generation ages into home ownership and incremental demand, again, from the work from home. So in turn, this allows homeowners to relocate, trade up, trade down. It's really, in my view, the lubrication for the housing market and turnover. And all of this is occurring against the backdrop of a shortage of housing stock that will not be resolved anytime soon. So putting the above together suggests that turnover, at least to me, is going to continue to emerge as a dominant prepayment theme going forward.
So Glenn, given your view that turnover will be dominant theme going forward, what sectors within mortgages do you prefer?
Yeah, so first I'd like to frame the rate environment, right? So I think the bias, geopolitics aside, is to a higher rate environment and a steeper curve. So in the near term, the risk is a flight to quality trade, a flattening curve, those types of things. But so with this in mind, I try to take a kind of a balanced look at what I call the kings of extension protection and the princes of call protection, right? So the kings of extension protection are really the relocation sector, followed by the jumbo spec pool sector, and then finally the discount new production loan balance sector. And then the princes of call protection are New York, followed by the belly of the loan balance sector, the intermediate coupons, and then finally the intermediate coupons are the belly of the Florida and Texas spec pool markets. So in my view, the macro environment and prepayment landscape really argues in favor of the kings of the extension protection more so than the princes of call protection. But that also carries in it sort of a more of an intermediate term rate view.
Finally, you sent a February 24th client note on the mortgage basis. Has your view on the basis changed since then?
Yeah, well, that note was motivated by a continuing widening of the mortgage basis, right? And so, our 2022 outlook had called for a high on the mortgage basis of 100 basis points. So once that was hit and the basis was closing wider on several consecutive days, I thought it would be a good idea to review the basis outlook and share my thoughts on that. And when I think about the basis, I do a couple of things. First, I like looking at long-term monthly charts and intermediate-term weekly charts. And these give me a sense of the trends and the extremes. So looking at like long-term monthly charts, we see extreme basis widening, say greater than 110 basis points with volatility events. So the dot-com bust, deflation, scare of the early 2000s, the financial crisis, the taper tantrum, the pandemic, right? So all those things can really push the basis out to extreme levels. But still, the long-term trend has been to a tighter coupon basis, right? Current coupon basis. And so currently, if you look at kind of the shorter intermediate trend has been to a wider basis, and we keep testing this 110 on an intraday basis. And when one looks at the 110 on the chart, it is a wide spread absent a volatility event. So, naturally, or certainly we're in the midst of a volatility event that could take the basis wider, but it just looks to me like the basis is beginning to consolidate around 110. And so, at this point, I just don't feel the current coupon basis would hit an extreme evaluation. And so it may be in this consolidation phase around 110, but, we'll kind of see. But that's where my thought process kind of is coming out on that.
Thanks so much, Glenn. We certainly have covered quite a bit of background here today. But to sum it up, it sounds like you favor adding the kings of extension protection with the basis trading around 110.
Yeah, that sums it up pretty nicely.
Great. Well, there's a lot to unpack here. For those that are listening in, some of the references that we made to reports that were sent out this month, please reach out to your salespeople if you do not have those or would like to follow up with Glenn directly. And thank you to everyone for listening to the MUFG Global Markets Podcast. You could go ahead, rate, review, and subscribe on Apple, Spotify, wherever you get your podcast, and reach out to your MUFG sales rep for any further information. Please check back soon for more insights from the Global Markets Research team.